Passive income from rental properties. What is real estate passive income? The IRS defines passive income as regular earnings from either a trade or business activity you don't materially participate in during the year, such as dividend income or royalties from a book. Rental activities, even if you do materially participate, unless you're a real estate professional. Passive income from real estate includes any income generated from rental activities and other real estate investments. Real estate passive income often requires an upfront investment that generates recurring income. Some passive real estate investing demands more hands-on management, while others are truly passive. Real estate investing isn't all about flipping homes. Long-term focused rental investing provides several sources of income. Much of the media coverage on real estate investing focuses on making a quick buck, buying cheap properties, slapping some lipstick on them, and then flipping. Hopefully, you make more reselling than you spent fixing the place up. At any moment, you can find one of 5 or 6 TV shows based on this practice on TV. But for long-term focused real estate investors, that approach can be akin to day trading. When you flip houses, you're betting on a quick turn in the market for that house. Of course, you spend time and money helping that happen, but for most people, there just isn't the same level of consistent gains that you can get in long-term rental property investing. 1. Rents. The first source of passive income on rental properties is the rent you charge tenants. In this example, you earn $33,000 per year from rent and have to make $27,840 in debt payments. On the surface, that's $5,160 of passive income per year. Of course, there are more expenses than that. Depending on the property and the lease, you could also have expenses for property taxes, utilities, maintenance, repairs, management, income tax, WA fees, and even lawn gnome replacement. It's possible that a property won't be profitable at first. The key is to stick with it for the long term. If you choose a property in a good location, your rent rates will slowly grow over time while debt payments stay the same. 2. Capital gains. You have capital gains when you sell the property for more than you paid. If you purchased the example property for $500,000 and sold it 5 years later for $550,000, you'd have a capital gain of $50,000. That's a 10% gain over 5 years, which is not great. In long-term rental investing, capital gains usually aren't the source of returns. And if you're making good income through rents and the other 2 sources of income we discuss later, you won't want the capital gains anyway, because that would be giving away the golden goose. If you do buy a property that has a rapid increase in market value, there is a way to access that gain. Let's say the property is in a great location and the price doubles over 5 years, not much different than what has happened where I live in Utah. You could refinance the debt on the property with a new appraisal and take cash out to use on another investment. Otherwise, you'll only access capital gains when you sell a real estate investment. 3. Tax write-offs. The problem with having a profitable rental property is the taxes. If you don't plan ahead and make estimated tax payments throughout the year, you could be hit with a surprising 5-figure tax bill come April 15th. The good news is there are tax write-offs you can take advantage of. The key write-off is depreciation. Depreciation is a non-cash expense that you can claim on your tax return to reflect natural deterioration of property value over time. Residential rental properties are depreciated over 27.5 years, so that means we can write off $18,182 per year from the example property. This is a legitimate tax expense that you don't have to pay for. It's possible to own and rent a property that declares a tax loss each year while being cash flow positive. That means you don't pay taxes on it but receive cash from it. Another write-off is interest expense. When you finance a property, you pay interest each year on the debt. In the example, total interest in the first year of the loan is $17,219.80. This amount is deducted from rental revenue when you report the income on your taxes, even though, as we'll discuss in a minute, it's effectively paid by your tenants. 4. Debt paydown. The final way that you make money on rental real estate is debt paydown. Let's look back at the capital gains example. The property was sold for $550,000, which I said was a 10% return. That isn't technically correct. It's better to look at the cash-on-cash return. The property was purchased with 20% down, or $100,000. Over 5 years, the debt was paid down to a balance of $403,916. You receive $146,084 in the sale, which is good for a 5-year return of 46%. That's not life-changing but definitely amplified by the power of leverage. The best part is that the tenant is making those debt payments. If you can rent the property for more than the monthly debt payments, you've created a situation where the tenant makes the principal and interest payments and you can write off the interest and get the full benefit of the reduced debt. Long-term investing is the way to go. As with stocks, long-term investing in real estate based on the fundamentals is the best way for most people to generate consistent income. If your rents fall short or you end up having a larger than expected tax bill, you still have other sources of income from each rental property. 5. Ground leases. Ground leases enable you to generate passive income from owning land instead of a building. You own the land underneath a building that you lease to the building's owner. A ground lease generates predictable passive lease income and tends to be a very low-risk investment. Ground leases offer less income potential in exchange for the lower risk profile. They also have a relatively high upfront cost to purchase the land. 6. Short-term vacation rentals. Short-term vacation rentals are an increasingly popular way to generate passive real estate income. You buy a home or condo in a vacation destination and rent it out to leisure travelers. Short-term rentals tend to command higher rental rates than long-term rentals, making them a potentially lucrative source of income. As a bonus, you can use your vacation rental when it's vacant. However, short-term rentals aren't exactly passive since there's lots of work involved in managing a rental. A vacation rental is more like a hospitality business than a real estate investment. You can hire a property manager to turn it into a passive investment, but they charge a significant portion of the rental income in fees. Short-term rental properties have a high upfront cost. You'll typically need a 20% down payment, plus closing costs and some cash in reserve for vacancies and repairs. Vacation rentals also experience high vacancy rates, especially in off-peak times and during a recession, making the passive income rather lumpy. 7. House hacking. House hacking is a way to generate income from your current home. There are many forms of house hacking, including buying a duplex or fourplex and living in one unit while renting out the others. Renting a room in your home to a family member or college student, or converting a garage or basement into a small rental unit. House hacking provides rental income to help offset part or all of your living expenses. However, it's not entirely passive income. For example, you might need to fix something a renter broke, and it can be an invasion of privacy. House hacking can require a large upfront cost to purchase the investment property or make a space for renters, and it has some additional tax implications. 8. REIT mutual funds. REIT mutual funds are a lot like REIT ETFs. They hold a basket of REITs, enabling investors to gain broad exposure to the sector. A manager actively manages the mutual fund, aiming to buy shares of the REITs they believe will deliver superior performance relative to a benchmark index. Because of that active management, REIT mutual funds often have a higher expense ratio than REIT ETFs. They also tend to have a higher minimum investment, typically around $2,500. Usually you'll need to purchase a REIT mutual fund through a broker. Like, comment, share and subscribe to my channel.